Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of structuring and smurfing. These are two common types of crimes. Sometimes they happen inadvertently because the person just doesn't know it's a crime, but it's the idea of limiting deposits or spreading out deposits into the bank, other financial institutions to avoid detection. The two types of reports that are commonly made by the bank is the Currency Transaction Report, CTR, Suspicious Activity Report, SAR. So with structuring, what happens is a person limits how much they deposit into the bank at a certain time. Let's say they have $30,000 to deposit. Instead of making the deposit now, they deposit $7,500 a day over, let's say, every 4 days to avoid detection. That's structuring. There is no reason to avoid doing that other than a person doesn't want detection by the U.S. government. That is unfortunately a crime. When foreign accounts are involved, acronyms such as FBAR and FATCA come into play, which I'll go over a bit in a minute, and that increases the intensity of the investigation. Smurfing is a little different. With smurfing, what you're doing is, let's use an example, right? Examples make it easy. Let's say you had $15,000 and you wanted to deposit all on the same day, but you don't want the bank to report. So what you do is maybe you have 3 different people go to 3 different institutions and each of them deposit $5,000. That way, no bank is going to exceed the $10,000 currency reporting or currency transaction reporting. And then it also avoids suspicious activity because just somebody walks in and they deposit $5,000, it's not going to do anything. Now, one problem that we've seen it's common when other attorneys come to our website and they kind of just take pieces and try to put it together, doing it correctly, and then try to scare the public. Not every split deposit is illegal. For example, let's say someone owns 4 different businesses, and those businesses are 30 miles apart. Each one of these are cash businesses that are accurately reported, just they're cash businesses. So at the end of the day, the owner grosses up the income and splits it into 4 different bank accounts. Each one is next to one of these particular businesses. Well, that's not structuring. Splitting up deposits for your business purpose in and of itself is not a form of structuring. If you do structure or smurf, then you have to be careful of the different crimes that the IRS will try to enforce. Let's go through some of them. There's tax fraud and tax evasion, common. Now, when international is involved, you also have issues involving FBAR and FATCA. FBAR is Foreign Bank Account Reporting. FATCA is Foreign Account Tax Compliance Act. You may have international wire transfer audits. And then when it comes to enforcement, the IRS, they can go after you with liens, levies, seizures, passport revocation. And quite frankly, even if the money's in another country, the U.S. has entered into so many different bilateral tax and enforcement FATCA treaties that the chance of them being able to work or communicate with the foreign institution is much higher, especially if it's like a Citibank or something that is originally U.S. but has lots of overseas locations. If you're out of compliance and you want to get into compliance before the IRS catches you, there are various amnesty voluntary disclosure programs available. There's a traditional voluntary disclosure, which is where it takes out where OVDP left off. It's for people who were willful or cannot certify under penalty of perjury that they're non-willful. There's the streamlined filing compliance procedure. Streamlined filing compliance procedures if someone qualifies domestic and foreign, and there's also delinquency and reasonable cause. We have lots of free resources on our website, goldinglawyers.com. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.